All right, so you wanted the inside scoop on Bank of America's latest earnings call. And
Lots to unpack.
yeah, let me tell you, there's a lot to unpack. Get this. Remember a year ago when BofA basically said, yeah, Q2 2024, that's going to be the low point for our net interest income.
Right, they were calling for an inflection point.
Exactly.
Yeah.
And guess what? They nailed it. But what's really interesting is that NII didn't just grow in Q3. They're projecting even more growth in Q4. And get this, even with rate cuts on the horizon.
Yeah, that's what makes this so intriguing. They're pulling this off because their core deposits, particularly those stable checking accounts, are stickier than expected.
Right.
People aren't chasing higher yields as aggressively as some anticipated.
So it's less about the sheer volume of deposits and more about their composition. Those loyal customers with steady checking accounts, that's their secret sauce.
Yeah.
But before we get too deep into the weeds on that, we need to zoom out for a second. You asked us to analyze this earnings call within the context of the overall economic climate, and right now it's a mixed bag. We're seeing this stable but slowing economy, inflation finally easing up.
It's like the economy is tapping the brakes. Consumers are still spending, but they're cautious. It's reminiscent of that 2016 to 2019 period, slow and steady growth.
Makes sense. Inflation might be down, but no one wants to go on a spending spree just yet. And then you've got businesses facing those sky-high borrowing costs. How are they holding up?
Businesses, especially the smaller guys, are feeling the pressure. They want to grow, but that high cost of borrowing makes them think twice about taking big risks. So it's a balancing act for them, too.
Okay, so we've got cautious consumers, businesses walking a tightrope, and in the middle of it all is Bank of America reporting on the surface a pretty solid quarter.
Yeah.
Their Q3 earnings came in at $6.9 billion with $25.5 billion in revenue.
And while those top-line numbers look good, it's the details beneath the surface that reveal their strategy. For example, they're seeing a huge surge in investment banking and trading fees, which is great for revenue, but
But it comes at a cost. Those big bonuses, the high-stakes talent war, it all eats into their efficiency. They're making this strategic bet, accepting some short-term pain for what they believe will be long-term gains.
precisely. And this is where the digital transformation comes in. They've got 75–90% digital adoption across their business lines, which in theory should translate to lower costs, right?
You'd think so. More automation, less reliance on physical branches. It seems like a recipe for a leaner operation. And yet their efficiency ratio is actually getting worse. So what gives? Why isn't this digital prowess translating to a better bottom line?
That's a million-dollar question, and it all circles back to those strategic investments we were talking about.
It's like they're saying, yeah, we could squeeze every penny right now, but we're playing the long game. They're doubling down on these high-growth, high-reward areas, knowing it might mean shelling out bigger bonuses to attract and retain top talent.
Exactly. It's a calculated risk. They're betting that these investments in areas like investment banking will pay off down the line, even if it means their efficiency ratio takes a temporary hit.
Okay, so they're sacrificing short-term efficiency for what they believe will be long-term gains. But how does that square with their push for digital transformation? You'd think more digital adoption would equal greater efficiency, right?
You'd assume so, and to be fair, they're seeing impressive progress on that front. But it's not a simple equation. Digital transformation isn't just about cutting costs, it's about reimagining how they do business.
So it's not just about replacing tellers with ATMs. It's about fundamentally changing how they interact with clients, how they manage risk, how they make decisions.
Precisely. And that takes time. They're building the infrastructure for a more agile, digitally driven bank, and that requires significant upfront investment.
Which, of course, circles back to the efficiency puzzle. They're investing heavily in both their digital future and these high-growth areas like investment banking, and those investments come with a price tag.
Exactly. It's a delicate balancing act. They're trying to drive profitability in the short term while also laying the foundation for sustained growth in the future. And that means making tough choices about where to invest and where to streamline.
So it seems like they're playing a bit of 3D chess here. They're making strategic moves across multiple boards, knowing that some of those moves might not pay off immediately. But they're playing for the long game, betting on their ability to adapt and thrive in a rapidly changing financial landscape.
And that brings us back to their core message of responsible growth.
Yeah.
They're not just chasing profits at all costs. They're trying to build a more resilient, future-proof bank, one that can weather economic storms and emerge even stronger.
It's a bold strategy, that's for sure. And only time will tell if it pays off. But for now, they're riding a wave of momentum. Their Q3 earnings beat expectations. They're making significant investments in their future, and they seem to have a clear vision for where they want to go.
But it's not all smooth sailing ahead. The economic outlook remains uncertain, competition in the financial sector is fierce, and there's always the risk that their big bets won't pay off.
Which is why we're here, right? To
Yeah.
dive deep, analyze the trends, and help our listeners make sense of it all. And speaking of making sense of it all, I think it's time for our final thought-provoking question. Ready for this? What if everybody's got it wrong about interest rates? What if instead of dreading a return to a normal rate environment, around 3%, what if that's actually where Bank of America shines?
That's an interesting way to look at it. Most analysts are focused on the potential short-term hit from lower rates.
Right, but think about it. While other banks are scrambling for deposits, BOFA is sitting on this mountain of low-cost stable funds. That's their massive base of loyal checking account holders we were talking about.
Ah, I see where you're going with this. You're thinking that in a normal rate environment, that stability becomes their secret weapon.
Exactly. Less pressure to offer those crazy high-yield promotions, more room to maneuver. It could be a game changer.
It's certainly a compelling argument. Of course, whether that advantage outweighs the cost of their strategic investments, the pressure on their efficiency ratio, well, that's the million-dollar question.
And that's the beauty of it, right? It's complex. There's no crystal ball. But what we've done today is giving you the tools, the insights to look at this earnings, call this bank strategy through a different lens.
It's all about connecting the dots, understanding not just what they're doing, but why they're doing it, and then asking those what-if questions.
Because the financial world, it's not static, it's dynamic, it's ever-evolving. And the more you understand the forces at play, the better equipped you are to navigate it all.
So to our listeners, as you continue to follow Bank of America, as you watch this inflection point play out, keep asking those tough questions. Dig deeper, challenge assumptions, because that's how you turn information into insight.
And who knows, you might even teach us a thing or two along the way.
Until next time.
Happy investing.